Evercore ISI's top market forecaster thinks it is the wrong time to go bullish on stocks. Julian Emanuel is the firm's senior managing director. His S&P 500 price target is more than 10% below today's close. Julian, welcome. Is it harder and harder to stick by that forecast as markets go higher and higher?
Well, by definition, it is. There's no question about it. But let's think about it, right? The first 10 minutes of this conversation, we've been focused on valuation. Mm-hmm. It is something that I would say in the course of years of me being with you all, we've talked about very, very little. But the point being that, you know, whether it's the consideration of earnings estimates that in our view are far too high, even though we had a good earnings quarter, but good earnings quarter was up 5.5%. The market thinks the full year is 10.5%. At 23.5 times earnings, you know, whether it's the premier investment bank stock in the world or it's the market in general, we just think this is a time to really think about risk reward here. And, you know, Goldilocks, despite the fact that we're either at 2 or 1 or 0 cuts, continues to be priced very aggressively.
Guy hates Goldilocks.
Yeah, it makes me crazy. I'm giving Julian a pass because I love him.
Just don't talk about it on Turkey Day.
We'll talk about gold in a minute, so.
Please.
But I mean, in terms of where we are right now and the risk reward, one of the big risk events in the markets we've been talking about for weeks now is Nvidia's earnings, which are coming up this week. Volatility is still extremely low right now. In general for the markets. And so I'm wondering how you reconcile that, and if you also think that, like many of the traders here, that Nvidia is actually going to be sort of the thing that either sets this rally higher or sets us back.
So it is one of the most unusual environments I think any of us have seen, because the amount of dispersion among stock returns is really record, which is why the index doesn't move. Think about today, right? We saw, you know, Jamie Dimon's bank sell off the way it did. At the same time, we had 2+ billion shares in a number of meme stocks that, frankly, people don't know what the companies do and never even heard of them 2 weeks ago, buying and selling them. So it is a very unusual environment. And to us, in total, it says that risk in general is perhaps overpriced here. And we just... It's not the end of the bull market, in our view, and I think that's the message we got from Jamie Dimon today. It's just a time to sort of let things settle in for a while.
Julian, what's the deal with the VIX? I mean, we talk about the headwinds all the time, geopolitical stuff, blah, blah, blah. Closed below 12 on Friday.
It's incredible. It goes to the dispersion. It also goes to the fact that the game has morphed for now into one-day options, 0-day and one-day options. The one-day VIX today traded in the 5s, the lowest ever for the 2 years plus that it has been calculated. And from our point of view, when you think about it in the context of Nvidia, it is true. That stock has been the market for the last year, and it's going to move. We're not sure which way, but the options market says it is going to move, and we expect the S&P to move with it.
All right, Julian, the stock market hasn't worried too much about where yields are, right? And again, even when we started the year and there were 6 cuts that were priced, and now, you know, we have maybe 1 or 2 this year. Let's talk about inflation for a second here. So if the Fed keeps saying that, you know, 2%, they're going to stay pat with like higher for longer, that sort of thing. At some point, do you have to start figuring out what the cumulative gains have been since we got above that 2% and kind of took off into 2022? Because, you know, do they have to actually keep yields much longer for, higher for longer than a lot of folks think that they might have to do because of those cumulative gains over the last few years?
I think that's some of the dialogue. And as much as we may not want to acknowledge it, there's no question about the fact the feedback loop from equity prices into confidence, into financial conditions is definitely there and has been for a number of years in central banking. And, you know, people want to compare this to 1995, the dawn of the Internet revolution. We're fully behind the idea that generative AI is going to be a game changer over the long term. But the difference between now and 1995, where you basically had a straight shot up for 3 years uninterrupted, is the Fed started cutting rates into the kind of economy we have now when inflation was already 2.1% versus 2.8 now, and stocks were trading 14 times, not 23 times.